now. Without further ado, let's move on to Jake and Gino. Let me stop sharing my screen. We can talk to these guys.
Al, it feels like I'm speaking to Jake right now. As you led the presentation, you were like Jake. You were just like machine gunning, like going, bulldozing. That's what Jake does. Jake just bulldozes and gets through it. Good
We
job.
wanted to get to you guys.
Good
So,
job.
I thought about how I would introduce you guys, but then I thought maybe you guys should just do it yourselves because you guys are into so many different things. What I will say is I've been listening to your podcast for years and it's awesome. I've been in deals with you guys that have been very lucrative and so happy to have you on the podcast
Thanks for having us. Jake, you
or
want to take it away?
your podcast on our Zoom.
What? Yeah. So no, appreciate you having us. So Gino and myself are, both originally from the Northeast. We were, I was working in the White Plains area up until 2011. Gino had a restaurant in Mayapack, so I was going around using him as my prime resource. I was a pharmaceutical rep out there doing sales, like everybody here, so we know sales well. And had to go to the right spot. Gino was catering all of my lunches and different events, so we had a relationship. I don't know, Gino, what, maybe 2008, 2009 when we first met, something like that.
We met in 2009, yeah, through my brother actually. And when we met, we just both did not want to be in New York anymore. We both wanted to get into real estate. I was on the hamster wheel. I was working every week. I was making a few bucks a week. One week I wasn't making money. One week I was making money, and I'm like, I have to find a different vehicle. And I had already invested in real estate. I had lost a ton of money. I had made money. And when I met Jake, I'm like, dude, real estate? And he popped the question when he goes down to Knoxville, Tennessee. He moves down to Knoxville in 2011 when I didn't even know where Knoxville, Tennessee was, to be completely honest with you back then. I'm like, where are you going?
I think most people still don't, Gino. It's okay.
And I'm like, it's a great place. And, we got together. It took us 18 months to find that very first deal in 2013. And if you want to show the stats of what we've done since then, but I think more importantly than that, I'm a father of 6 kids. Oldest kid is 25, youngest kid is 10. We homeschool the kids. Jake's got 3 kids. And I know when Jake met me, he must have thought I was one of the weirdest people on the planet because I was homeschooling back then and no one really homeschooled back then. I had a big family. I was into organic. I was into everything that Jake wasn't. And over the years, he's slowly come over to the dark side. Now he's homeschooling.
It's just called growing up, Gino.
Is it called growing up? Now you're homeschooling your kids and you're eating clean and you're doing a lot of the stuff. But it really comes down to, I love the relationship I have with him. I've grown with him as a partner. It's not Gino, it's Jake and Gino. And what you guys are doing here with Al leading you guys and with teams, it's so important to find the right person or the right people to surround yourselves with. And I'm just, lucky and I'm blessed to have that boy over there as my partner.
Yeah, and I don't even know if I've ever admitted this before. Al, you may not know this. I'm actually a real estate broker. Ooh, believe it or not. I feel like I got to admit that out in public. And the only reason we have our own property management company, we got about 80 team members on there. And it was sort of a requirement. I got called out at one point for not having it. So they said, you got like 3 months to get this. And thankfully I was an agent before. So we went through that so I could comply with the great state of Tennessee. And that's what we're doing. Never sold a piece of real estate in my life though. So just to be transparent.
Being a realtor that bad, it sounded like the first time you admitted you were an alcoholic for a second. Like,
no, but
I have to admit, I have a problem. I'm a real estate agent.
No, but it's comical because I have a business that required it, but I've never used it for anything. It's a requirement of the state because they wanted me to have it for, having a property management company. So I just comply with the laws. Al.
There you
so
go.
I just go along with it. But gang, I think our main objective for today is we all have, a primary source of revenue. You guys are out there, selling these homes, millions of dollars and you're making your money doing that. But also over time, you want to invest that money and make that money work for you. One of Gino and my favorite books is The Richest Man in Babylon. And that book essentially talks about, having your money grow for you over time and investing that money and having a purpose for each one. We joke around and call it baby money soldiers. Your money needs to have, babies, and those babies need to have more babies, and it needs to keep growing over time. And we believe in long-term thinking. We still have the first real estate investment that we ever purchased together. We haven't sold it, and it's continued to make money for us. I think it's put 2 of Gino's kids through college. It has great tax advantages. We obviously do apartments. We're going to get into that a little bit, but there's various ways to do it. You don't have to be the primary source. Just for transparency's sake, Gino and I own all our own investments. We've done syndications. To Al's point, we've actually purchased over 2,200 apartments in our career. We still own over 1,800 of those, and everything in our portfolio is owned by Gino and myself. We actually stopped doing outside investments, but we're going to talk about that today because it's a great way to grow your money over time. So you make a nice commission. You need to do something with it to really, have that freedom that you want. So we're going to talk about the different ways you can do that. Again, Gino and myself, our model is we actually own and operate these things. We go out and the profitability from these apartments is what pays us every day. So we know the vehicle very intimately. We're going to talk about that a little bit, but also other ways where you can partner with folks and what to look out for and safeguard your investments. So that's what today's talk is about. And we have the Gino here, the G Daddy, who is an expert. And so you guys are very lucky to have him. And he's going to break it down for you.
Jake, can you just go through the slides? Yeah, this is what we have right now. 2,200 units, $350 million in assets under management. We've got 80 plus full-time team members. And that's been just an amazing thing to see because I had one restaurant for 20 years. And with Jake, in 5 years, we had almost, 700 units. So it's been just for me an amazing transition from being the mom and pop to actually having an amazing portfolio. And our Jake and Gino community on the next slide, they've done some amazing things over the last 7 years. They've been able to purchase over 85,000 units, over $5 billion in transaction volume. And for me, the cool thing is Jake and I don't raise money anymore, but our students have raised almost $700 million for their deals. And the reason why I put this deck together and the reason why I want to talk about investing passively is because a lot of us start out and passive investors have made a ton of money over the last 5 or 6 years, but the last couple of years have been really challenging. And I sat back and I said, what was the difference between now and 5 and 6 years ago? And how did I start my journey? And the big mistake that I made early on investing passively. So Jake, if you want to get to that 3-step framework, let's jump into that and show them what it is.
Before we do, I want to expand upon that a little bit because, everything with real estate is a cycle, right? It cools off, it heats up. You guys know it. You're seeing it every day. And the thing that we saw in this last part of the cycle was people got overly aggressive for deals because there was a lot of money that was printed. People were going out and looking for a place to put their money. And ultimately, if you give a syndicator money, they're going to use it, right? And what we saw was a lot of these deals that were being purchased were used with bridge debt. So this was, floating rate debt, trying to force deals to work because they saw high rent increases. Unfortunately, at a certain point, that's not buying right. That's speculating, and that's where people got caught. We've always preached long-term fixed rate debt. We've never personally taken on bridge debt. And one of the most interesting things about multifamily is you work with the agencies. Okay, Fannie Mae, Freddie Mac, those loans are very safe and secure. They're non-recourse. And they won't do a deal if it doesn't make sense. So if you have to go stretch to do a deal, people tend to go to bridge financing. If you look to the agencies, you look to the insurance companies, they're going to give you their guidelines and what they're willing to partner with you on. And if it doesn't fit those boxes, that's what happened in the last part of the cycle. People attempted to do an end around and use this bridge debt. And that's where a lot of them got caught and people invested in these deals. So what we're going to talk about today is, if you're out there, you're selling a lot of houses, making good money, you want to partner with a syndicator or a sponsor, what good looks like to do that. And that's what Gina's about to dive into right now.
I'm going to share the story, Jake, if you don't mind, about Maserati
Sure.
Mike. But before I do, this is the framework. And really, when you're looking at a deal passively, the very first thing you need to be looking at is the sponsor. What most of us do is we've got some money, and what would we do? Where's the deal? Where can I get my highest rate of return? That's the last thing that you should be looking at when you're trying to invest passively. The sponsor is the first thing. That's the jockey. The second part is the saddle, which is what I call the alignment of interests. Do your interests align with the sponsor's interests? If they do, great. If you like the sponsor, great. Then let's move on to the deal, which is what we call buy right, manage right, and finance right. In 2005, in my very first passive investment, I'm sitting outside of my parking lot. Gentleman pulls into the parking lot. He's got a nice gold Maserati. I called him Maserati Mike as soon as I saw him. I actually got introduced to him by my accountant, by my CPA. And he had mobile home park. And he says, Gino, you want to invest with me? And I knew nothing about mobile home parks. All I knew is I had a little bit of money and I was going to invest. And I always go by the concept now that I've learned, a person with money meets a person with experience. The person with the experience gets the money, and the person with the money gets the experience. That's what ended up happening to me. I've violated this entire framework. I go invest with Maserati Mike. I give him $172,000 of my money without looking at the property, without doing due diligence, without flying down to the property, without understanding cap rates, without Maserati Mike giving me any documents about syndication. Who knew syndication? I violated every one of these concepts that I'm discussing. 6 months later, Maserati Mike stops sending payments. 8 months later, communications are dead. A year later, I Google the property and the property is going into foreclosure. And I sat back and I was so pissed off and I was blaming Maserati Mike. And that's what a lot of us as passive investors do. We blame the sponsor. We blame the investment. When ultimately what we should be doing is we should be blaming ourselves. We should be taking responsibility. And I thank God that I did that because it led me to multifamily. It led me not to blame Maserati Mike. It led me not to blame my situation. I said, what do I need to do? Well, I needed to learn the business of real estate. And that's what made me focus on multifamily and what led me to Jake. So when I'm looking at that whole Maserati Mike scenario, I can break it down into these 3 different pillars. And Jake, if you want to go to the next slide, I think this is what most of us on this call need to do. We need to think about the sponsor. And in the next slide, I'll show you some of the things that you need to be looking at when you're looking at a sponsor. Next slide, brother. Woo. So when you're looking for a sponsor, look at their track record. Unfortunately for me, this is where Maserati Mike checked the box. He had done deals. But remember, in 2005, I don't know if a lot of you are old enough to remember, that was the upcycle. So anyone with a heartbeat was making money in real estate. And guess what? 2019, 20, 21, 22, anyone with a track record with a heartbeat is making money as well. So track record is not the only thing that counts, but it does count for something.
How long was his track record though, Gino?
He had about 6 years in the business, believe it or not. He was buying, he had several mobile home parks, but I didn't understand anything about it, Jake. If I had just gotten on a plane, flown down to it and going, this is what I'm buying, I would have spent $500 on an airline ticket, but I would have saved 170 grand. If I would have looked at median income, if I would have looked at flood zones, I would not have bought that property, but I didn't know that. I didn't understand his business plan. His team, he didn't have a team. I mean, this was his sheets. I mean, like he was sending me sheets over. His communication style, terrible. So when you're looking to partner up with somebody passively, you have to focus exclusively on the general partner, that person leading the deal. But not only that, all of their team members. And Jake was joking around before, and Al was joking around, don't be a broker, Alcoholics Anonymous. I think brokers are the most important.
Oh, I wasn't joking about that. I just never tell anybody because I don't actually sell real estate. And I feel like that's the primary reason to have a real estate license. I didn't mean it in a bad way. It's like, it's super challenging.
But Al took it in a bad way. And I get it.
Yeah, no, it was my delivery.
Yeah, there's a lot of hating on brokers, but the reality of multifamily is brokers are the gatekeepers. You guys are the ones who are bringing us deals. And for you to assemble a team, brokers are important. If you're
it's a very challenging job. Even from like a residential, I give you guys so much credit because I've purchased homes before, and I've sold a home once, and the emotions and the roller coaster that everyone goes through. I mean, you guys deserve every cent of that commission. I firmly believe that. So hats off to you all. So I didn't mean for that to come across in the wrong way, but
no offense taken.
And so when you're looking at the GP, other team members, you're looking at their, if you're looking into a syndication, their CPA, you're looking at their cost segregation, you're looking at their property management, you're looking at their asset management, you're looking at a lot of their different team members, and you're looking at the other people on the general partnership team. There may be a lead sponsor. Let's say Jake and I are doing a deal, we're lead sponsors. There may be other people. Listen, this may sound exhaustive, but once you found the sponsor and you like it, then you can check that box. This is the biggest mistake that I see investors make. They're just willing to look at the deal and saying, hey, you know what? I'm going to hand this person over my money and I'm not going to do my due diligence. So it's so important that you vet that sponsor. And I think, Jake, you want to go to the next slide? I think this one.
I want to say one thing on it too, Gino, because you're going to get to in a second here, but depending on, your level of risk, have they done a full cycle deal? That may be there, but maybe they haven't, but you're getting more of the deal because they haven't, and that's worth it to you. And Gino's going to touch on this in a second, but it's not really crystal clear. but maybe it's more of a Venn diagram, Gino. I'll tee that one up for you. So
Before you go to the next slide, let's go back to that one because that's important.
sure.
I'd rather invest with the Jake Stenziano, who has maybe 30 units, who's really hungry.
That's your preference, though. Keep in mind.
That's what I said. That's what I said. I'd rather invest with someone who's young, who's hungry, who's got a lot to lose, and who's got a lot of skin in the game in a deal than someone who has a fund, who has 40 or 50 different assets, and I put money into his asset, and the deal goes bad. Not really going to lose anything. I mean,
well, but it's probably not going to go bad. It's it's probably going to get a nice 5 to 8% return, right? And so there's that piece to it too. So I think.
But Jake, what you're saying, what I'm saying about the track record is don't always look at the track record. You may be able to find a sponsor who's young, who's doesn't have as much experience, but is hungry and is riding on it and will do anything. Will be the Facebook, maybe the Zuckerberg sleeping on a futon just to get this deal over the line. So don't discount the hunger and the willingness of the person by just saying, "Hey, you have to look at the totality of it." I think that's what I'm trying to really.
Al, you've invested in some deals. What do you like?
I was just going to ask you guys, how do you, I like what you're saying, the young, hungry person, but how do you differentiate between somebody who's young and hungry versus young and inexperienced? Where does that cross over, into being a good idea versus going with somebody who's inexperienced?
I think it's multi-factored, right? I think it depends on how much money you're putting in the deal, how much money you have in relation to how much money you're putting in that deal, and how much you actually believe in the deal itself and the person's ability to execute. It's a challenging question, and that's why I think many times and that's why I was sort of debating your real time with Gino there, because if you have couple $1 million in the bank and you want to try 50,000 or something with an inexperienced person, well, maybe that's not that big of a deal. If it's your last 50 grand, I would not ride it on someone with less experience, even though it may be a killer deal and you think they're going to execute.
But you also
there's a lot of personal preference there.
You have a lot of leverage on that deal as well, because if you're inexperienced but you need my money, you can get more of that money, more of that deal out, because
that's the point that Gino's making.
Person needs you, but you need him, but he needs you as well. And I think that's what I would be looking at. The word that Jake and I like to use is values-based decision making. I mean, anytime you make a decision in life, it has to go according to what your values are. And if you don't know what your values are, or you're just making decisions, well, you're going to end up making some of the wrong decisions. I think that's why Jake and I have been together for the last 15 plus years. We really, our values really aligned well. There was integrity, there was long-termism, there was commitment, there was hard work, there was family. And then I think sort of that's how you got to choose a GP. It's based upon how do they resonate with you? How do they communicate with you? Are they making excuses all the time? Are they not telling you, hey, I didn't have a draw? I would actually go online, and if you're looking to find a sponsor, just Google the sponsor's name and find out the deals that he owns. Call up those deals. See what their property management's like. Are they getting back to you 3 days later? Do they have any kind of systems in place? And if it's me and I'm putting 100,000 or 200,000, I would literally fly up to the property, go around the sites and drive around the neighborhoods, get a feel for what the neighborhoods are and get a feel for that person's property, see how they're running. Because if he's going to buy a new deal or she's going to buy a new deal, it's based off what they currently have right now. So it's important that you actually find out how this person is actually running their thing. And for me, lining up values is important. Every time I've made a mistake in business, our values didn't line up. And that's what happened with Maserati Mike. He was lazy. He was sloppy. He was inefficient. He didn't take care of the properties. He had no skin in the game, and he was a fly by night. And that did not align, totally misaligned with what I was doing. And that's why the deal ended up blowing up.
Yeah. And I just want to say something for everyone's, information from our perspective here. I think right now we've done one deal a month for the last 3 months. So we've closed on a larger, size multifamily deal, one a month for the last 90 days. And it's because we buy deals for cash flow. We're looking for cash on cash return. And this is the best market for actually acquisitions that we've seen since probably 2018. Mm-hmm. And so we're very active right now. It's the fourth deal that we've done this year. Again, it's our own capital. We're putting our money where our mouth is. And it just makes more sense when, it's like the Warren Buffett thing. When people are pulling out, right, you're kind of going the opposite direction and back in. And that's been our experience this year. So I think there's a lot of opportunities for folks right now that are looking, because ultimately a lot of the folks that are out there buying right now have, been raising money for the last few years. Their deals may not be performing. And so people are more reluctant to give them money. So I think there's actually some very interesting opportunities in the marketplace right now. Just to say that.
Jake, Debbie has a great question. Would you say everyone has a different risk tolerance? How much of the factors into your decision making? I'm writing a book.
Big time.
I'm writing a book called Happy Money, Happy Family, Happy Legacy, and it's almost out. And it talks about your relationship with money. Most people do not understand what their relationship with money is, and more importantly, they don't know what their money persona is. Are they, the avoider? Are they the gambler? Are they the spender? Are they the saver? Are they the investor? I think before you even put any money into a deal, you need to create a foundation for yourself and understand what your relationship to money is. I was a great saver. I had 2 immigrant parents from Italy. I was always told save for a rainy day. Don't know why it was a rainy day, but it was always a rainy day. So I could save like you would not imagine. But then when it was time for me to pull that money out, it was really scary for me. I didn't enjoy spending money, and that's not good either. But once I made the connection between I was saving money to buy an asset, and that asset would pay for the event, everything changed for me. And I'm like, okay, now I'm happy to save, and I'm really happy to
explain
invest.
what that means, Gino, because it sounds nice, but I think people may not, just
sure
for saving for an event.
Yeah, so
for an event.
We are in this country told to save for retirement, save for college, 529 plans, 401k plans, save for college, whatever it may be. And I was going down that road. But once I understood, hey, I've got this money, I'm going to save it, and I'm going to buy my first deal with Jake. So we bought our very first deal with Jake. That deal has been able to pay for my college kids, for my first 2 kids. I still own that asset. That's the asset is still producing cash flow every month. If I had saved money and put it into a 529 plan, that money would have evaporated. It would have been gone. The event is over. So understanding that, for me to understand, to put that money into an asset, whatever asset is, it may be self-storage, it may be whole life, if you're using whole life, whatever the asset looks like. I think if you're conditioning yourself to do that and understanding the relationship with money, obviously, when I started out in this business, there was more risk, but you try to delever the risk by understanding a plan and by using a process and by doing smaller deals and by tipping your toe in the water. And once you start doing that, you'll get more confidence and you'll end up getting more results. But you really need to start out with the relationship you have with money. Now, this next one is important, Jake, because this one, I totally blew it with Maserati Mike. The alignment of interests. Well, did Maserati Mike have any money in the deal? He had 0 money in the deal. Now, I didn't know that back then. I'm like, oh, I'm putting money in the deal. He had no risk. So if the deal went south, he's just going to walk away from the deal. And that's the thing you need to understand. Is your sponsorship group, do they have skin in the game? Have they put capital into the game? That to me is telling. If I'm going to be doing business with Jake, I want some sweat equity, obviously, but I also want them to feel the pain. If this deal goes south, he's going to work a little bit harder to get the deal over the line. I think the second part of aligning with interests, the important thing for me when you're aligning interests is the risk. If you're hearing sponsors say guaranteed 8%, no risk, and if the sponsor doesn't sit down with you and have a really heart-to-heart conversation about your financial plan and your financial goals and doesn't get to know you, and the first question out of their mouth is, how much money do you have to invest? Don't walk away from the sponsor. You run from that sponsor.
I think they call that commission breath.
I like that, commission breath. And, when you think about it, you're putting your hard-earned money with somebody and they can't take 5 or 10 minutes to learn a little bit more about you. To me, it's insulting, but not only insulting, there's a fiduciary responsibility for me to understand, hey, you only have $50,000 left in the bank. Real estate's risky. I don't think you should put your last $50,000 into my deal. That's the kind of sponsor that you want. Where are you getting your funds from? Oh, you have some money in an IRA account that you're not going to touch for the next 10 years. How about putting it here? Understanding that to me is really important, discovering the risks. And I think the third one, we can list a lot more, the time frame. If you're going to go into multifamily or in any kind of real estate, it's in a liquid asset. So if you're expecting your money back in the next 12 months, 24 months, it's probably not going to happen. So if those alignment of interests and you're saying, I need my money back quick, and the sponsor says, sure, I'll get it back to you, but he knows it's a 5-year deal or a 7-year deal, don't invest with that sponsor. Just get out of the deal. So make sure your interests are aligning with the sponsor. And
That's my favorite thing about multifamily, though, Gino, is that it should be paying you every month, right? That's the idea, is for a dividend type return, and ultimately you can't just get out of it quick. And I like staying in these deals for the long term. You get the tax advantage, and you hold it there. You get your money back maybe on a refi, and you repurpose it into the next deal. That is my favorite strategy, and I think the fact that it's not very liquid is a good thing, because it keeps people in something, that the investors into a deal where ultimately, if it's population growth, a decent vintage, people need a place to live, and so it's not a gadget or a doodad. That's why one of my favorite things about multifamily, it's probably less reliant on fancy marketing things, because ultimately it's a basic human need. And it's going to be there and always have a certain value to it. So I absolutely love it for that reason, because marketing is crazy. You get out there and you're winning based on how much you spend, how cool your ads look. You can get a pretty basic apartment ad, and get that sucker leased pretty quick. So I don't know.
Jake, Lucky asks, what's a typical cash on cash return you would offer to LPs? When we had our 3 syndications, on average, on the 3 syndications, we had a little bit over a 20 IRR when we exited them. But what we offered them was an 8% preferred rate of return. That preferred rate is a hurdle rate. So the first 8% of all cash flow goes to all the limited partners. And then after 8% to 11%, it would go to the general partnership team. Then after 11%, it would be split, whatever the co-promote was, whether it's 70-30 or 80-20. But typically there's a hurdle rate. And it is part of the market cycle right now. You're going to see anywhere between 6 to 8% is what LPs really, really desire, really need to be in this deal. Now, some deals may not offer preferred rate of return. Some deals may be a development deal. They may be a value add deal where there's no cash flow going in, but understanding that and saying to yourself, well, has the sponsorship team ever done one of these deals? I mean, what does it look like? What is their track record on that? So understanding the alignment of interest. Are you willing to forego cash flow today to make a bigger lump tomorrow? That question only you can answer.
And the way we look at our deals, just to give some transparency, we actually don't even look at that. We look at what we call profit per unit. We do a draw report every month. So we have our 1,800 apartments, and we look to average $300 per unit in profitability. So we look at each asset, and then the cool thing is too, on the draw report, you can see which assets are really performing versus others. And there may be a reason for that, and you may look for more of that. We tend to really focus on, we love townhomes, we love units with garages, we love washer dryer hookups, because we see a longevity in terms of retention from the residents. And that's really big, because your most expensive unit is your vacant one. And the more times you have to turn these things over, the more costs go into it. So we really look at resident retention and PPU. And that's one of the things that we probably look at more than anything else when we're doing our monthly reports.
Jake, Rennie asks, do you prefer multifamily or mixed use assets given the current state of retail? Rennie, for me personally, Jake and I we're striving to become the Chick-fil-A of apartments. We want to have superior customer service. We had the opportunity to buy RV parks a couple of years ago, and we didn't want to, because it was a different asset class. It was a different model. And it was at that point where we're not doing deals. What are we doing wrong? We almost jumped into a different asset class. For me, I would stay away from retail. I'm not a big retail person unless you're in a market and you're buying something at 50 or 60% occupied and you can get the occupancy up. Office, I don't know what's going to happen to office. I'm just not a big fan of office. A lot of these old buildings built in the 70s and 80s in office, it's going to be really, really hard to repurpose those, self-storage.
I think mixed use is really sexy. But again, guys, I'm just looking for that, offering a good, quality service to my resident, and then looking for that PPU, right? That profit per unit, and honing in and getting really good at one thing. And the fact that it's a basic human need, there's demand for apartments. People need a place to live. It's just easier for us to be, singularly focused on this. We're something that folks need every day. Look, there's hurdles to development, people getting in and the amount of apartments into certain areas. So it's just been really good to us. And I think the key is if you buy right, manage right, and finance right, you don't overpay for these assets. You don't use bridge debt. You have a good management team in place. Look, we've been doing this, since 2011, and have continued to grow. And, you look back 10 years ago, for say, we were buying units at 30,000 a door. And then you see the inflation and the run up on these things. Your spread, your profit per unit spread will go like that because you didn't get greedy and sell, because your complex doubled in value, and it has doubled your cash flow literally within a couple of years. So there's real benefits to long-termism and buy and hold strategies. We like it. Look, people have made great money by selling in the last few years. I'm not hating on that. It depends what your objectives are, but I think for the long term, it can be really interesting for sure.
A couple other questions, Jake. To add to that, it's cheaper to rent than it is to buy. So that's why we like multifamily still nationwide on average. Maybe it's a little more skewed up in the Northeast, but on average, everywhere else, it's about $2,900 per month to rent versus $3,700 a month with mortgage. So people are still deferring to that. And I think the second part is the demographics have shifted. It's not the American dream anymore. There's a lot of people that want to rent for a year or two, and then they give the keys back. So I think for us, there'll always be a demand. Debbie asks, do you prefer to stay locally, or are you doing out-of-state deals as a beginner? So Debbie, when I started in New York in 2008, I actually had to go up to Rochester, New York, because I wanted the cash flow. So I, started doing stuff out of state remotely. I learned how to deal with property management remotely. I loved it until I met Jake. I'm like, well, if you're going down to Knoxville, I'm going to have boots on the ground. Well, let's partner up and let's do something together with boots on the ground. So for me, it's more about finding a market. And if you're looking for a market right now, I would personally look for a market that you can get to that's really easily. If you're saying New Jersey, it's just the deals aren't there. Well, find a market that you like, but that you can jump on.
There might be deals in New Jersey, though. We don't.
Yeah, but I'm just saying, like, let's say you want to go to Pennsylvania or you want to go to North Carolina. If you want to invest out of state, don't go to Phoenix, right? That's just too far for you to get to, because you're going to have to get to the market, talking to other brokers, doing property tours. So if you're looking to go out of state, see if you can go out of state within an hour or two of a plane flight at the most. That's what I would say. Best place to look for deals, for me personally, is the Southeast. I just see the migration there continuing. I see the jobs continuing to grow. I think what happened in the last part of the market cycle, where you had that tech boom and what was going on, all these jobs were leaving California, these high paying jobs, and they're going to Raleigh, they're going to Charlotte, they're going to Nashville. And we've seen that, and it's continuing. And, obviously Florida's been going crazy, but we like markets like Tennessee. We like markets like North Carolina, growth, because basically it's a supply and demand. If you're, losing residents, if you're losing population, and there's a steady, number of units, your rents are going to go down. That's the reality. So we're always looking for places that have population growth.
Well, Al, you guys boomed after COVID too, because you had a lot of people pushing up from the city, right?
Yeah, definitely. We had a ton of people moving out of Manhattan into our area. Yeah. Excuse me, I got a cold. I have a question for you guys. When you talked about doing deals within an hour, you're talking about if you're the GP, or if you're doing your own deal, you're not talking about passive investing.
I'm sorry. Yes, please forgive me. Yeah, because it seemed as if she was talking about that. Yes, if you're a passive investor, that's the great thing about being a passive investor. You can go into multiple sponsors, you can go into multiple states, you can go into multiple deal types. So that's the great thing. When you're investing passively, you're putting money into all these different deals. You have the ability to diversify into so many different areas. You can go into Austin and get a multifamily in Austin. You can go into Florida and do an Airbnb fund. You can go into North Carolina and you can do a single family fund. So that's the great thing about it. When you're passively, you don't have to be close. All I would say is, on your first couple of deals, when you're investing passively, get some eyes on it. I mean, trust me, it is so worth it. After you've done 2 or 3 deals, you sort of get the feel. But that first couple, when you're starting to put hard money down, it's just, I just, and if the sponsor says, hey, you know what, don't bother me, then you know what, pass on the sponsor.
But that's the values, alignment. Yes. That's not there. And I think, to Gino's point, if you're going to be running the deal, you need to be able to get to it. But still, the point that we're really trying to drive home today is that even if you're passive on a deal, we still think it's a good idea to follow the framework. To Gino's point, is there population growth? Okay. Is the economy growing in that area? Is it in a flood zone, right? Have you done, some of your own underwriting to make sure what they're showing you is correct, right? Do you think it's going to cash flow, et cetera? What's the debt look like? What's the management look like? It doesn't need to take a week to look at all this stuff. And that's the thing, it's great. We've been doing this long. We can move very quickly. But I think in the beginning, look, $150,000 to Gino's point, that was a significant amount of money to him at that point in his life. You don't want to light it on fire. And that's the idea behind following our framework, is that if you're going to put the money into a deal, underwrite it like you're buying it for yourself, because you are, right? You are going to be a part owner in that deal, and you still need to be responsible for vetting what the information that the sponsor is giving you.
Jake, as
I
you
like what
look
you
at,
said. Sorry, Gino, that
no, go ahead.
use the framework, whether it's passive or active. Maybe can you guys go into the framework? Because I'm thinking that'll work for passive investors, but we have a lot of people on here that want to do their own deals as well. So that would apply to both groups, right?
Yeah, Jake, let me jump on this real quick. As you go to the next slide, Lauren asks, how do you
Oh,
recommend
L.
how do you recommend finding out-of-state sponsors? Woohoo!
It was the next slide. I'm joking.
So Lauren asks, how do you find out-of-state sponsors? You can go to websites like Cashflow Portal. These are all these investment CRM platforms. A lot of them are posting on their sponsors, GPs. They're going out there and they're listing sponsors on there. I would just Google multifamily, for me, multifamily syndicators, and you'll see a bunch of names popping up. You go on their websites. I would opt into every single one of their websites, opt into every single one of their offers, and start receiving their offers and start comparing. It's like going to the store. You're comparing apples to apples. That's really, really important. And investment minimums, Larry, typically it's $50,000 to invest in a deal, in a sponsorship, in a sponsored deal, but as low as $25,000 typically to get into one of these deals. Now, if you're going into crowdfunding and all that kind of stuff, it's a lot less expensive. Wouldn't recommend doing that. I recommend finding somebody who's got a deal and just understanding who the sponsor is instead of getting the crowdfunding. Jake, you want to jump in the 3-step framework and just take them through it?
Yeah, we'll go through this, guys, and we have options if you want to do passive coaching. It's really cheap. Gino, how much is it to do work with our coaches to help review deals and things like that?
Oh, its program is $8,500.
Yeah, it's nothing crazy, but you can actually have someone help you vet deals and things like that if you're looking from a passive perspective. But what I'm going to do is this is how we look at deals. So I'm going to kind of give you our framework in terms of what we look at when we're buying internally. And again, this is what we're looking for. Everyone has different criteria depending on what they want. But so we call it buy right, manage right, and finance right. We really believe that multifamily investing is a 3-legged stool. We use a wheelbarrow to represent that. We believe once you buy it, that's fixed. That represents one of the back legs. We believe in long-term fixed rate financing. That represents the other back leg. And then the wheel is manage right. That's constant. It's in motion. And if any of these things falter, your deal is going to get wobbly and could potentially collapse. And that's why we use the wheelbarrow as representation for that. And obviously, you want to fill your wheelbarrow with assets over time and make bank, right? Make some serious cash flow over the years. So for the buying criteria, we prefer, not that we haven't, but we prefer 1980s vintage or newer. There's concerns mostly there from plumbing perspectives. Roofs have probably been replaced at that point. But we prefer 80s or newer. We touched on this before. We love townhomes. It's more of it's like the halfway point to build to rent. If you guys are familiar with what build to rent is essentially single family home communities that are being built to just rent out now. We have some of those. They've done very well thus far. So that's another interesting thing for folks to look at. Really, really want the washer dryer hookup. Love garages if at all possible. Silly things, even from like exterior. If we're going to have a garden style apartment community, we'd like to have no sheetrock in the breezeways. That's typically something we'll go and repair if we have to do vinyl or whatever in there. That drives me nuts because it just looks so terrible over time. We prefer pitched roofs. And then you kind of go back. If you get in the 60s, some of this older crazy plumbing stuff can be a nightmare. So we tend to stay away from that. 2 bedrooms in our market have been better to us typically than ones. They're less transient. 3 bedrooms, there's not a huge supply in our market of 3 bedrooms. So when we see those, we gobble those up because we find a premium gets attached to those units. So it's these little things and local market knowledge and expertise that can grow over the years. We like minimum $50,000 median income. We work with local authorities and different search things to look at crime because that can be a big issue. And typically when you see the lower median income, it's just kind of the facts, the crime follows. So that's, that becomes a problem. And then delinquencies rise on the property. So, minimum 50 grand, 60 to 80 is real nice. So that's a big number to look at. We don't touch flood zones. And I've had, people bring me deals before that look great, but they've been in a flood zone and look, it's probably never going to happen. And then you see Asheville, North Carolina last week, and some of this stuff. And I'm not making light of it by any means. It's serious. And it's something that as an owner, if I can avoid that, I will avoid it like the plague. So we just, don't do that. We had some with components and whatever, and we're just like, hey, we knock on wood, we've never gotten in trouble with it, but we're just avoiding that completely these days. So as you can see, we start to create, this framework of this is what we're looking for. That way, when a deal comes across our desk, we can analyze it pretty quickly before we have to, dive into the financials. We like a 8%, minimum cash on cash return once the deal is stabilized. We have a team now where we go in, we renovate, usually every unit that hasn't been touched in years, and then we hold it and we harden the asset. Meaning like we're talking about, if we need to put vinyl in the breezeways, we do luxury LVP flooring, those types of things that we're going to get a long term out of, 30-year roofs, whatever. When it comes to the management, that's a little more proprietary to us because we do have our own management group, we have our own management systems, but most of that's driven by our cadence. I'm sure, Al, for example, how often do you guys do this meeting?
Every week.
Every week. So it's the same kind of thing. Like we meet with our property managers every week. We have a level 10 meeting with them. We've done traction coaching, we've done scaling up coaching, we've done some more, and we've essentially merged those into our own management systems that we follow. But you'll see on the weekly reports that there's, minimums that we look for delinquency and occupancy. And, even as far as we track the water bills on a weekly report, because we know that anything over $50 typically is a leak. And, we bought so many properties where the water bill is $80 per unit per month. And so that's a great way when you're seeing these master metered communities to get ahead of that stuff. So it's a cadence of accountability when it comes to the management. And if you're going to be using third-party management, or if you're going to be working with a sponsor, you still want check-ins and certain benchmarks for them to meet. And if you are going to go out and do your own deal and use a third party, I suggest having that weekly cadence touch point if it's a larger community, if not every month, and look for those different KPIs for them to be pushed to you, not for you to have to go get them. So create that cadence where they're sending you the forward-looking updates, not, oh, the month ended, we had 10 vacancies and we spent a shit ton of money. Because there's nothing you can do at that point. If they're sending the stuff in real time and you're looking for trends, you can actually get ahead of it and make a difference. And then the finance right component. We touched on this quite a bit. One of the biggest things that we will not do floating rate debt. We want to sleep at night. We want the debt to be fixed. Sometimes we go on, on the front end and maybe work with a community bank or a credit union where we'll do something called loan to cost. I'm sure most of you guys are familiar with that, where we'll have a renovation cost baked into the loan. And the minute that, the work is done and we like where the 10-year treasury is at, we'll take it out to Fannie or Freddie and fix it for a minimum of a 10-year term and a 30-year amortization. We call it sending it out to pasture. And, you going back to this last part of the market cycle, we had deals that were 4.5%, and people are like, oh, you got 4.5% debt, hold your nose. Anytime you're going to give me 4.5% for 10 years, I don't care if the rates drop to 3 or whatever. I am tickled pink. It's fantastic. The deal is cash flowing. It's non-recourse. And that's the ultimate goal when it comes to this long-term fixed rate financing on that end of it.
Jake, let me recap this real quick for everybody, because you can use this framework to buy a business. You can use it to buy self-storage. You can use it to buy a single family home. You need to buy the asset properly, and you need to set up your own personal buy right criteria. And that's as if you're a passive investor as well as an active investor, or you're buying a business. What are you trying to buy? The second part is the manage right of the business. Once you bought that business, you need to manage it. And if you're not managing, somebody has to. And the third component is the finance right. Are you using creative financing? Are you syndicating the deals? Right? Are you using SBA loans? Are you using a community bank, credit union, whatever that looks like? Just get a fundamental understanding of that. And you need to put all three of those together. And when you're buying the asset, once you have those three, it's going to make your asset work and function better. Because there's two ways I think you lose money in real estate. You either run out of time or you run out of money. So if you're actually managing it right and you have proper budgets and you have the proper financing, you're trying to delever the risk. And that's what you're trying to do with this framework that we've created. We got like 2 minutes left, Jake, to talk about the market cycle. And, I'd heard somebody before say that the economy looks good, this and that. I'm here to tell you that the economy sucks right now. And that's a good thing for real estate investors because that means prices are going to come down. Inflation is here to stay. I don't care what they're saying. They dropped to 50 basis points, did nothing to the 10-year treasury. Actually,
No, 10-year went
up
up like 40 basis
yeah.
points.
So to me, they're caught in a pickle because they tried to juice the economy. They failed, and they know. And anyone who owns a business understand that there is inflation. Inflation has not gone away, but that's a good thing because if you're trying to get into real estate and trying to understand, now's the time for me to start reaching out to brokers because brokers have really not done much deal flow over the last 12 months. They're hungry to hear investors. They're hungry to talk to investors. And if I'm a sponsor or a GP, I haven't done a deal in a while and I haven't been able to raise money. So I'm here to be able to talk to other investors. So to me, now is the time.
Don't be afraid
to make me funky, okay? Like that.
Yeah. I was just going to second what Gino said. I think the point, the take home point here is this is a good time, in our opinion, to be investing. And so, getting off the sidelines, I think you're going to actually see, and we've seen some really interesting deals. And like I said, we've done, 3 deals in the last 90 days. And so it's not, our deals are less frequent than your typical residential type deal. So that's for us, that's a big deal. That means we're doing a lot of activity right now. So I just think that, sometimes when the economy drags like this or is stagnant, folks, tend to stay on the sidelines waiting for something to happen. And then, opportunities can pass them by. So I would just, if you're interested in investing, I would be hyper alert right now to potential opportunities out there.
Al, I'm going to send you over our underwriting template because Lauren is asking about 3 specific ways or a sheet that we recommend analyzing a property. I'll send that over and I'll send you over a copy of our Honeybee, a PDF. So I want to get this out to all the brokers you have out there because this is creating multiple streams of revenue. Because when you're making money in your real estate business and you're getting commissions, I want you to grab that money and put it into an asset that's going to create another stream of revenue for you. And I'm really impressed and I admire what you've built there, Al, because you live by this model. You've got different businesses. They're working in such a beautiful symbiotic relationship. We can all do that. All we need to do is just start. And for me, this book will help you start creating multiple streams.
Thank you for that, Gino.
I will send it over. Jake, if you want to just throw on the last slide, we just have a QR code there. That's our link tree. If you want to get our social media, we've got a podcast that's been running for the last 10 years or so. If you want to sign up to the podcast, it'd be great.
So before we go, or we see if anyone has any questions, I have a couple quick questions. So you guys do a lot with coaching. Do you want to talk a little bit about how that works, how the different forums that you have for passive investors, how that all works?
For us, we've seen there's a shift in the marketplace, and I wanted to create this LP program because I was really getting mad at everyone complaining about how the deals went bad and LPs are mad at GPs, and I just wanted to teach LPs how to underwrite a deal.
LP is a passive investor. It's a limited partner.
Limited partner. Yeah, I wanted limited partners to be able to say, hey, how do I underwrite this deal? So I created that one-on-one coaching program as an LP investor, as a passive investor. If you've got a deal and you don't know, bring it to one of the coaches that we have. They'll underwrite the deal with you. They'll show you the math. They will help you in understanding what multifamily is and how to underwrite a deal. So we have that. And then we have the Jake and Gino community where we have masterminds and one-on-one coaching there as well. That if you want to become active, that's the other side where you're saying, hey, I want to become active. I want to start doing these deals myself. So there's 2 facets of it. There's the passive side and the active side. And I think Jake and I think we're proud enough to say that we're probably one of the only educators out there that has an education company that does not raise capital from their students. We don't have a community to say, hey, I'm going to teach you how to do this business. And oh, by the way, I've got a fund or I've got a deal that I want you to invest in. That's not what we're here for. We don't do that. We want to really teach people the business because ultimately, if there's an LP or a passive investor that finds a deal that's bad, they're not going to invest in it. That price has to come down. This is bringing equilibrium back into the market. That's what we're trying to do with passive investors, giving them the opportunity to understand that, hey, this is a deal. We need better passive investors out there to hold the general partners and these sponsors, to account.
So if folks want to learn more about the passive or active investing, is it just go to the link tree? Is that the best place to find out more information?
Yeah, just go to the QR code. Be great.
We're, easy enough, jakeandgino.com as well. You can check out the podcast and everything.
All right, cool. One other question. We have a lot of, hopefully some of them are still on, but folks in this group that are actually coaches themselves and podcasters. Do you have any advice for building a coaching business? And maybe that's a whole nother Zoom, but building a coaching business, building a great podcast and generating a following?
I would say purpose over popularity. I found that to serve myself well. We're always focusing on how many numbers and how much revenue, and that's all great. But if you focus on your purpose and why you're being a coach and why you want to help people, that will give you the fuel that you need every day, because it's a tough business. Doing multifamily, in my opinion, is a lot easier to do a deal than it is to build an education.
Yeah, the coaching side of it's way harder than the actual.
That's my own opinion. I mean, the coaching is great, and we love the coaching because we get on these calls every week. Jake's a hermit. Jake never leaves his house, so for me to have him mastermind and network with people, I've got to have the education. So we have guys on our podcast every Tuesday, and it's great. We get to speak to Robert Kiyosaki and T. Harv Eker and Dr. Gary Chapman. That's what the education and the coaching business should be all about. I think it should be supporting your other business and how they work so well together. One monetizes the other. We're learning about maintenance on our show and all this kind of stuff. So for me, focusing on your purpose, focusing on who you want to serve, I think that's really important. And don't make it free. People do not respect free, and they're going to waste your time. And I know that's hard. I want to help as many people. You got to let them pay something. It's skin in the game. Once again, if you have them invest in themselves and you have them understand that they need to show up, they need to do the work, I think to me, that's going to help you in your coaching business. Jake, what say you?
What year did we start the podcast?
2016.
Okay, so it's 2024. We have not missed a week over that 8-year span of releasing a podcast, and many weeks we release multiple. And so I think what happens with most folks is they dip their toe in the water, and one week they're kind of a coach, the next week maybe not, they go for 3 months. It's a consistency issue that I see with most people. The market is going to cycle, like we talked about. If you go back 2-3 years ago, multifamily was the hottest thing, right? The coaching, and this is the interesting part. Our coaching business was at all-time high, right, but our acquisition business was at an all-time low because we were trying to buy for cash flow. Now everyone's like, oh, the deals are, whatever. And so the interest rates go up. Our coaching business has pulled back a little bit, but we're buying more deals than ever. So it's interesting. Gino talked about these symbiotic relationships. One may be hot, because something's happening, and it's all interest rate based. I think a huge percentage of it is a huge part of it. So look, you can't be in it, for a little bit and then not be there. You got to show up every week, regardless if you want to or not. And I think it's consistency and dedication over time, because that's what it takes to build a brand. And I think, be respected and trusted in the space. If you're not going to be all in all the time, with your content, if you're doing a podcast or with your coaching, it's not going to work. And it's hard. I'm not saying it's easy, but I think that's where most people flounder is. They get a couple of tough weeks and then they're out, and then the market picks back. Oh, I'm going to be back into coaching this week. Not saying anybody on this call is doing that, but I've seen that, throughout the years, and it's the consistency and longevity where most people struggle, I think. So
Al, you find your voice, be authentic, and be transparent. And I think if you can do that, that's what this world needs more. We need more authenticity. We need more people coming on, showing their true colors, not being afraid to say what they believe, and being open and honest with all your failures and all your successes. If you can do that as a coach, you're going to have a great business.
And respect to the team that's out there door knocking.
Yeah.
Good for you.
Yeah. I love that.
All right. Well, I think that's a good note to end on. I really appreciate you guys coming on. You guys are awesome. This was super helpful. I'm getting a ton of good feedback in text and in the chat. So thank you so much. And hope to connect with you guys soon. Thanks, everybody.
Thanks, Al.
See you. Thank you, guys.
See you guys.